Welcome to Markets Plus, where leading experts from across BMO discuss factors shaping the markets, economy, industry sectors, and much more. Visit bmocm.com/Markets Plus for more episodes.
In this episode from Macro Horizons, Ian Lyngen and Ben Jeffery bring you their thoughts on the U.S. rates market for the upcoming week of June 22nd, 2026, and respond to questions submitted by listeners and clients. Let's dive in.
This is Macro Horizons, episode 379, Sunny Sunday, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery to bring you our thoughts from the trading desk for the upcoming week of June 22nd. The summer solstice is at hand. That is, the astronomical first day of summer in the Northern Hemisphere. On Sunday at 4:24 a.m., the Earth's tilt will be its closest to the sun for the year. Happy Father's Day to those who celebrate. Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, there were two major developments of significance for the U.S. rates market. First was the FOMC meeting. This was Warsh's first meeting as the chair of the FOMC, and there were some pretty dramatic changes made to the statement, most notable of which it was far shorter than had been the case previously. For context, the statement was 130 words, compared with April's statement, which was 341 words, and March, which was 306. This move signals the new chair's stance on communication, specifically delivering a more concise statement and leaving aside forward guidance. The Fed events also included an update of the SEP, which saw the median dot for 2026 revised up to 3.75%, suggesting that the Fed has a modest bias to hike rates this year, as opposed to the assumption at the beginning of the year, which was that rates would be normalized lower over the course of 2026 and 2027. It's also worth highlighting that the long-run dot unexpectedly slipped to 3.06 from 3.12. This implied that while the Fed is committed to fighting inflation in the near term, over the long run, they still continue to view neutral policy rates at roughly 3%. In terms of other meaningful changes at the Fed, Warsh announced 5 new task forces to review key areas of monetary policy, specifically Fed communications, the balance sheet, the use and reliance on existing data sources, productivity, AI and jobs, and the inflation framework. Warsh did go out of his way to confirm that 2% remains the Fed's inflation objective. While he did hint to being open to revising that at one point, he also observed that before that discussion could begin, we need to get inflation back down to 2%. Our primary takeaways from Warsh's debut as Fed chair is that he has delivered on brevity, if nothing else, and he is laying the groundwork to make the type of changes that many in the market anticipated. Specifically, there now appears to be a path to remove or significantly limit the SEP and the dot plot. Revisiting the size of the balance sheet is undoubtedly on the table. And the Fed is likely to emphasize new data sources in its monetary policy making decisions. In terms of revisiting the inflation framework and reframing productivity and jobs, those are longer-term conversations that we expect will persist indefinitely at the FOMC. The other major event that occurred in the week just past was that Trump signed a deal with Iran, and Iran is expected to countersign that on Friday, which creates a 60-day ceasefire and reopens the Strait of Hormuz. As a result, energy prices declined, with the front-month WTI contract back below $75 a barrel, highlighting the possibility that oil could return to the 55 to 65 range that was in place prior to the war. Such a significant sell-off was seen as unlikely after the front-month contract reached 108 at the peak of the energy shock. As we think about what the decline in energy prices could mean for the consumer, if nothing else, what had been upward pressure on headline inflation over the course of the last several months should transition to a period in which inflation is biased lower, especially given the decline in gasoline prices. For context, the average cost of gasoline in the U.S. dropped below $4 a gallon for the first time since April. Overall, the resulting price action in the Treasury market has been a very significant curve flattening impulse. The 2-year sector remains comfortably above 4%. In fact, the front-end benchmark looks as if it might be anchored to roughly 420. Further out the curve, duration has actually outperformed and is richened in outright terms. As a result, the spread between 2- and 10-year yields dropped below 25 basis points, leaving us now with a near-term target of 15.8 basis points, which would represent the flattest the curve got in 2025.
Well, Warsh's first Fed meeting is in the books, and we have a monetary policy decision that frankly leaves a lot of the other prevailing themes that have been driving the market over the past several months intact, especially ahead of the long holiday weekend in the U.S. and what feels like increasingly summer trading conditions. The bigger questions around what's going on in the Middle East and the state of the domestic economy remain intact, specifically the Memorandum of Understanding and the framework to get the Strait of Hormuz reopened, the timing of which has been set out at more or less within the next 30 days. However, the realities of lifting the naval blockade, clearing mines, and the other logistics surrounding opening a major shipping channel leave no shortage of uncertainty around when it is exactly we will return to pre-war levels in terms of oil shipments out of the Persian Gulf. But with oil now back not quite to pre-war levels, but certainly far closer to $60 a barrel than $100 a barrel, the market is comfortable taking the MOU at face value, which should help moderate the most severe follow-on inflationary concerns from the energy price spike. However, in the same way that the Fed was reluctant to respond to oil on the way up, we're skeptical that over the medium term we're going to see a reaction from the broader committee from oil on the way down, and that instead will leave a fairly universally strong retail sales print as the most recent data point exemplifying that the domestic economy remains strong and arguably reaccelerating.
And it's that reacceleration argument that is really fascinating at this point. If, in fact, the U.S. economy was able to successfully withstand an energy shock of the magnitude that we've seen in the first half of the year, it's very conceivable that we find ourselves over the course of the next several quarters with an increase in consumption in outright and even real terms, a continued AI build-out, which has supported fixed investment in terms of the GDP calculation, all with the backdrop of moderating headline inflation while some pockets of core inflation remain sticky. Or, if nothing else, they present a wild card for monetary policymakers as we consider the balance of the year. All of this is consistent with an increasingly optimistic economic outlook as derived from the performance of the data thus far. When putting the Treasury market in this context, it does make it somewhat more challenging to assume that 10-year yields are going to drift lower over the balance of the summer and into the fall, which would, however, be consistent with the seasonal trading patterns in U.S. rates. At issue is the degree to which oil prices can truly retrace lower. We're open to the argument that one of the primary reasons that energy prices are as contained as they are at the moment is because once the Strait of Hormuz is finally passable, there will be a lot of supply hitting the market, and that will help firms rebuild some of the inventory that was drawn down over the course of the last 3.5 months, and then allow the market to once again engage in the process of price discovery and establish the new post-war range, which, if the recent trajectory is any indication, could actually be back in the $55 to $65 a barrel range. Now, the flip side of the discussion is worth engaging in, and that's the argument that oil prices are as low as they are now because there has been a decline in demand. Part of that being a focus on alternative energy, but part of that also being a reflection of a cooling growth profile in parts of Asia. Taken together, the logic holds that once supply is ramped back up, the conversation should be about a ceiling for oil prices as opposed to a floor. That is a remarkable shift in the energy narrative over the course of the last several weeks, to be sure.
And as the conversation was had in the early days of the war, it's also going to be interesting the extent to which we see a reversal of that negative growth hit as a function of higher oil prices. Said differently, an undoing of the tax on consumption argument and the fact that higher prices at the pump were detracting from spending elsewhere might now instead serve as a tailwind for consumption if in fact we do retrace and then some the entirety of the conflict-driven repricing that we've seen over the past 3 months. And especially looking at the departure point, with the control group retail sales figures in May coming in at 0.7% month over month versus the 0.4 gain consensus, it's hardly as if we saw a meaningful pullback in consumer spending last month when the national average price of gas was approaching $5 a gallon. And so while the longer-term cyclical concerns and disinflationary worries around AI are still firmly intact, if we see a pro-growth boost from lower fuel prices, at a point when we're already seeing such resilient consumer spending, then exactly as you touch on, Ian, it's entirely reasonable that the summer months could prove bearish for treasuries.
Ben, while I generally agree that that is the risk, the counter-argument is that we haven't really traded the growth aspect of the war in Iran and the global implications for demand destruction, by and large at least. The trading dynamic has primarily been following energy prices, effectively tick for tick. So if we're now on the other side of that particular hill, and the new pattern will be a persistent grind lower in energy costs, then one should assume that this will provide a drag on rates. If that isn't the case, and instead we pivot to trading off of the growth implications from the tailwind of lower gasoline prices, then one should put in context some of the recent strength in retail sales, specifically the fact that the retail sales figures are in nominal terms, and they are not inflation adjusted. So in a month where headline inflation is running at 5 or 0.6%, when one sees retail sales at a comparable level, we have to then look to the real personal spending figures. For the month of May, that data will be released on Thursday, June 25th, alongside the core PCE numbers for the month of May. On the inflation side, expectations are for core PCE to have increased a high 0.3 or a low 0.4. When we have those numbers in hand, and presumably they come in line with expectations, we will once again see a demonstration of the growing wedge between core CPI and core PCE. We do know that core PCE is the FOMC's favored measure, and so the fact that this divergence persists is somewhat troubling, although ultimately we do expect that core PCE will come back in line with the more benign core CPI figures that we've seen in recent months. Moreover, it's worth highlighting the fact that within the CPI series, the core goods figures actually declined in the month of May. And that's relevant insofar as we're not seeing any clear evidence of pass-through from either tariffs or elevated energy costs into core goods, which is where one would expect that to materialize. So, taking a step back, that helps support the case for the further compression of break-evens over the course of the coming months, which will certainly be accelerated in the event that energy prices continue to leak lower.
And despite all these reasons that we've articulated why it's not especially likely we're going to see 10-year yields back at 3.50 or 3% anytime soon, it's nonetheless important to consider that the market has also put in a meaningful rally since 10s touched 470 not so long ago. And in fact, even with the upside inflation risks posed by the oil shock and such a resilient labor market and Fed pricing having swung far more hawkishly than was the case to start this year, it's not as if there was a significant risk of 10s probing 5%, nor have we seen 30-year yields been able to trade north of that threshold for very long. And so, from an asset allocation point of view, the fact that any time we've seen meaningful bearishness in fixed income and rates break out to new highs, wobbles in the equity market, and more material demand for yields at higher levels still leave us convicted in the expectation that there might be episodes of selling in treasuries, but there's still enough structural demand at higher rates that we're unlikely at the precipice of a bond bear market. And even after the press conference, especially with what we know will be Warsh's longer-running focus on the balance sheet and Bessent's concerns about keeping the longer end of the curve away from higher rates, the fact that we have both the new Fed chair and the Treasury Secretary reluctant about pursuing policies that would trigger a resumption of a more material surge toward higher long-end yields over the medium to longer term continues to advocate for a dip-buying bias in 10 and 30-year yields.
Briefly returning to the conflict in the Middle East, as the MOU has outlined a 30-day period to reopen the strait, it does beg the question, if it's a 60-day ceasefire, there's 30 days to reopen the strait, and within that same period, the administration wants to begin the conversation about Iran's nuclear program. Are we simply setting up for another ceasefire extension debate at the end of the current one? That certainly does appear to be the case, which leaves us somewhat apprehensive at the notion that we're simply going to find ourselves over the course of the summer months with oil and gas once again flowing through the Strait of Hormuz and the bearish implications for the energy sector that are already being priced in.
So really, everyone just wants the summer off.
And to SIFMA's credit, they've given us 2 long weekends, effectively back-to-back. After all, no one works on the 26th of June. In the week ahead, the Treasury market will continue to digest the details that came out of the FOMC, and as a setup, the backdrop of the reopening of the Strait of Hormuz, the degree to which investors have confidence that oil will once again be flowing out of the Persian Gulf sooner rather than later, will continue to set the tone for the energy sector and, to a large extent, by extension, define how one should expect the longer end of the yield curve to behave. Clearly, the front end of the curve is simply going to be a function of monetary policy expectations over the course of the next year and a half, and those have been refined via the Fed. From the perspective of the incoming data in the week ahead, we do have the core PCE numbers for the month of May. The consensus is for a 0.3% increase. Either a high 3 or a low 0.4 seems to be the market's operating assumption. Perhaps more importantly, we'll be watching personal income. Recall that in April, personal income was flat during that month, which suggests that the impulse from tax refunds and the fiscal upside for the consumer, at least, was exhausted in the first quarter, which then begs the question, in the event that consumers are going to be able to continue to chase prices higher and expand personal consumption, will that come at the cost of savings, or will we see the bottom 2 quartiles continue to struggle to the point that it catches up with the aggregate data? In addition, within the details of the personal spending and income report, we'll be watching real personal spending, as that has the highest correlation with consumption in the GDP report. Recall that real average hourly earnings have been negative for the last 3 months, and at some point one should assume that that flows through to real personal spending. Although, to be fair, that dynamic is yet to materialize during this cycle. Moreover, when we think about the forward path of energy costs, specifically gasoline prices, we could find ourselves shifting into a dynamic where higher headline inflation had been weighing on real purchasing power to the flip side, when nominal wage gains are more than keeping pace with realized inflation. That would simply represent a reversal of the dynamic that has been in place as a function of the energy shock. Again, a lot of this is predicated on a true reopening of the Strait of Hormuz that then allows energy prices to once again settle back into the pre-war range. On the supply front, We do have 3 nominal auctions, including Tuesday's $69 billion 2-year auction, Wednesday's 5-year at $70 billion, and then the month's supply is capped by the $44 billion 7-year on Thursday. As a theme, the auctions have gone reasonably well, and we anticipate that will remain the case as June comes to an end. The week ahead does not officially contain month end, and so any related flows will likely be delayed until the following week, with a nod to Tuesday, June 30th, for such extension-related demand to arise. Keep in mind, June also represents quarter end, so we'll be watching the funding markets for any concerns or stress in the very front end. But frankly, the funding market has been behaving remarkably well and has yet to show any signs of reason for concern. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. And with summer officially starting with a long holiday weekend, followed shortly by the Independence Day break, we'll excuse ourselves for the visions of barbecues and friendly gatherings that are dancing in our heads. Just to mix holiday metaphors.
Thanks for listening. You can follow this podcast on Apple Podcasts, Spotify, or your favorite podcast app. For more episodes, visit bmocm.com/marketsplus.
The views expressed here are those of the participants and may not necessarily represent those of BMO Capital Markets, its affiliates, or subsidiaries. For BMO disclosures, please visit bmocm.com/podcast/disclaimer.
For full legal disclosure, visit bmocm.com/macrohorizons/legal.